Explain the free fall of the rupee, the Hindu. Why are countries increasing their interest rates? What are the ways in which the RBI has tried to cushion the fall of the rupee? The story so far, the Indian rupee hit an all-time low against the US dollar this week, weakening past the 79 rupees to a dollar mark and selling as low as 79.05 against the dollar on Wednesday. Many analysts expect the rupee to weaken further in the coming months and move past the 80 rupees to a dollar mark. In fact, the International Monetary Fund (IMF) expects the rupee to weaken past the 94 rupees to a dollar mark by FY29. What is happening with the rupee? The Indian rupee has been witnessing a steady decline this year, losing more than 6% against the US dollar since the beginning of 2022. India's forex reserves have also dropped below $600 billion, plunging by more than $50 billion since September 3, 2021, when forex reserves stood at an all-time high of $642 billion. The drop in India's forex reserves is believed to be largely due to steps taken by the Reserve Bank of India to support the rupee. RBI officials, however, have noted that the drop in forex reserves is due to a fall in the dollar value of assets held as reserves by the RBI. For instance, if a portion of the reserves are in euros and the euro depreciates against the dollar, this would cause a drop in the value of forex reserves. It should be noted that, as a matter of policy, the Indian Central Bank has usually tried to slow down or smoothen, rather than reverse or prevent, the fall in exchange value of the rupee against the US dollar. The aim of the RBI's policy is to allow the rupee to find its natural value in the market but without undue volatility or causing unnecessary panic among investors. State-run banks are usually instructed by the RBI to sell dollars in order to offer some support to the rupee. By thus selling dollars in the open market in exchange for rupees, the RBI can improve demand for the rupee and cushion its fall. What determines the rupee's value? The value of any currency is determined by demand for the currency as well as its supply. When the supply of a currency increases, its value drops. On the other hand, when the demand for a currency increases, its value rises. In the wider economy, central banks determine the supply of currencies, while the demand for currencies depends on the amount of goods and services produced in the economy. In the forex market, the supply of rupees is determined by the demand for imports and various foreign assets. So, if there is high demand to import oil, it can lead to an increase in the supply of rupees in the forex market and cause the rupee's value to drop. The demand for rupees in the forex market, on the other hand, depends on foreign demand for Indian exports and other domestic assets. So, for instance, when there is great enthusiasm among foreign investors to invest in India, it can lead to an increase in the supply of dollars in the forex market, which in turn causes the rupee's value to rise against the dollar. What is causing the rupee to lose value against the dollar? Since March this year, the US Federal Reserve has been raising its benchmark interest rate, causing investors seeking higher returns to pull capital away from emerging markets such as India and back into the US. This, in turn, has put pressure on emerging market currencies which have depreciated significantly against the US dollar so far this year. Even developed market currencies such as the euro and the yen have depreciated against the dollar, and the dollar index is up more than 9% so far this year. In fact, some analysts believe that the RBI's surprise decision to raise rates in May could have simply been to defend the rupee by preventing any rapid outflow of capital from India. In 2013, the rupee fell 15% against the dollar in about 3 months after investors were spooked by the US Federal Reserve's decision to trim down its bond purchase program that had helped keep long-term interest rates low. Moreover, India's current account deficit, which measures the gap between the value of imports and exports of goods and services, is expected to hit a 10-year high of 3.3% of gross domestic product in the current financial year. This means that India's import demand amid rising global oil prices is likely to negatively affect the rupee unless foreign investors pour sufficient capital into the country to fund the deficit. But foreign investors are unlikely to plow capital into India when investment yields are rising. In the US, yields on US 10-year treasuries, for instance, have risen from around 0.5% in mid-2020 to over 3% now. The rupee, it should also be noted, has consistently lost value against the US dollar for several decades now. A major reason for this has been consistently higher domestic price inflation in India. Higher inflation in India suggests that the RBI has been creating rupees at a faster rate than the US Federal Reserve has been creating dollars. So, while capital and trade flows gain a lot of attention in discussions on the rupee's value, the difference in the rates at which the US Federal Reserve and the RBI regulate the supply of their currencies may play a much larger role in determining the value of the rupee in the long run. What lies ahead? Analysts believe that, over the long run, the rupee is likely to continue to depreciate against the dollar given the significant differences in long-run inflation between India and the US. At the moment, as the US Federal Reserve raises rates to tackle historically high inflation in the country, other countries and emerging markets in particular will be forced to raise their own interest rates to avoid disruptive capital outflows and to protect their currencies. It should be noted that inflation in the US hit a 41-year high of 8.6%. The RBI too has been trying to rein in domestic consumer price inflation, which hit a 95-month high of 7.8% in April, by raising rates and tightening liquidity. As interest rates rise across the globe, the threat of a global recession also rises as economies readjust to tighter monetary conditions. The gist. The Indian rupee hit an all-time low against the US dollar, weakening past the 79 rupees to a dollar mark and selling as low as 79.05 against the dollar on Wednesday. Since March this year, the US Federal Reserve has been raising its benchmark interest rate, causing investors to pull capital away from emerging markets such as India and back into the US. This, in turn, has put pressure on emerging market currencies which have depreciated significantly against the US dollar so far this year. The RBI has been trying to rein in domestic consumer price inflation, which hit a 95-month high of 7.8% in April, by raising rates and tightening liquidity. Article 8.